Tensions in the Middle East are escalating due to the intense bombing in Beirut. The president of Lebanese Association of Social Medicine said that Israel has been bombing the southern suburbs of Beirut using banned bombs with uranium warheads. The latest, most intense strikes by Israel were made on October 6, targeting Hezbollah, nearly a year since the Gaza war erupted. Seems like the war is nowhere at its end right now, even after a year. Now, this has raised new uncertainties for the global economy. The new escalation, 2 weeks of intense airstrikes by Israel, could play out negatively on the world economy in the week ahead. Now, first understand what is the impact of the war on the global economy. The main effects of the war are limited to the financial markets as of now, as investors hedge their portfolios with safe haven assets. The US dollar has been the main beneficiary since Iran's ballistic missile attack on Israel happened. The dollar index is trading at its peaks. The index measures the US dollar against euro, yen, and 4 other top currencies in the world. Coming to oil prices edged up today as developments in Middle East took the center stage. Brent crude futures rose 45 cents to $77.63 a barrel, below the $84 levels at the time when Hamas attacked Israel a year ago. In the previous session, the prices had fallen more than 4% on the possible Hezbollah-Israel ceasefire. The drop in oil prices in the last 2 months was used towards calming down the average prices in order to reduce the pressure on public expenditure. As per Morgan Stanley, $10 per barrel increase can impact consumer prices by 0.2% to 1.4% points on the Asian economies. Now, if Israel attacks Iran's oil infrastructure, Iran would retaliate intensively. However, it is not clear that Israel will attack the oil infrastructure in Iran. Analysts say that this may not translate into a kind of sustained sharper rises as US has higher level of crude inventories, while OPEC nations have enough spare capacity to smooth out the impact. Last week, US President Joe Biden said that he will not support an attack on Iran's nuclear sites and cautioned Israel against attacking oil fields in Iran because this would intensify the conflict further. So everyone is watching Israel's next move. Till now, policymakers have also not been counting Middle East conflict as a major threat to their attempts to tamper inflation, but they cannot ignore the geopolitical tensions totally. IMF says that the escalation of the conflict may have significant ramifications for the region and the global economy. So how does it impact India as a whole? Since we are talking about oil prices, India is making higher imports of Russian oil due to the price discounts. But these discounts have also come down. So India's reliance on West Asian imports have increased to 44.6%. India has also opened up channels to boost Iranian oil imports after Jaishankar's visit in January. But the markets are not panicking yet given the surplus available. Next, the shipping companies. India's economic health heavily depends on trade. India needs trade routes passing through Gulf of Oman, Strait of Hormuz, Persian Gulf, and a safe shipping passage in the Red Sea to access the Suez Canal and enter the European markets. Now, the prospect of an Israel-Iran war puts these routes at risk. Any escalation could also delay India's ambitious trade route project, the India-Middle East-Europe corridor. Now, what Indian shipping companies are worried about is the rising cost of insurance premiums due to the security risks. Insurance costs have already risen by 30%, besides lengthening freight journey by 2 to 3 weeks. And the alternative route also leads to higher shipping costs due to the delay and impacts India's exports and imports. As per UN data, the transit volume has dipped by 42% versus the peak following the Red Sea crisis. Lastly, the markets. Gold prices go up during any time of uncertainty, and investors also choose to invest in safer instruments. Gold prices have reached multiple peaks this year, outperforming all other asset classes. Sectors like energy, automobile, and airlines are facing volatility. Sensex and Nifty also were facing volatile times this week over escalating geopolitical concerns. So far this year, FPI inflows into Indian equities have exceeded 1 lakh crore rupees, indicating global investor confidence in the country. However, experts warn that the trend could reverse if the tensions in the region escalates, impacting trade and oil prices. As per experts, IT, infra, and oil producing companies will see a negative impact. So all policymakers will be watching out is the Middle East tension to predict the future of the economy. For more such news and views, keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.